Hello and welcome! Today, we're diving deep into a really fascinating part of behavioral finance, cognitive biases. We're going to break down these mental shortcuts our brains take, the ones that can mess with even the best financial models and lead to some pretty costly investment decisions. So let's kick things off with a big question. We live in an age with incredibly sophisticated financial models, right? So why do we constantly see markets behave in ways that just seem irrational? Where does all this craziness come from? Well, the answer really boils down to two different kinds of knowledge. First, you've got your financial facts knowledge. That's all the stuff about how markets work, valuation, economics, the whole nine yards. But then there's human behavior knowledge, and that's all about understanding how we, as humans, actually behave. To really succeed, you have to master both. Today, we're focusing on that second one, the human mind.
All right, first up, let's talk about one of the most powerful biases out there, the framing effect. This is all about how the way information is presented can totally change our choices, even if the facts themselves don't change one bit.
Okay, let's try a classic experiment from the legends themselves, Kahneman and Tversky. Imagine this exact scenario. A disease is going to kill 600 people. You have two programs to choose from. Program A, where you know for sure 200 people will be saved, or Program B, a bit of a gamble. What do you pick? Well, when they ran this, most people were drawn to the certainty of Program A.
In fact, a whopping 72% of people chose Program A, the safe option. That preference for a sure thing is a really key insight. But now here's where it gets wild. Watch what happens when we just change the words a little.
Okay, take a second and look at this. The situation is identical. Program C, where 400 people will die, is the exact same outcome as Program A, where 200 people are saved, right? It's just framed as a loss instead of a gain. So which do you choose now?
And boom! Look at that flip. It's a brilliant illustration of the framing effect in action. Now, only 22% of people choose the certain option. This just shows a core idea of their work. When we think about gains, we tend to play it safe. But when we're faced with losses, we're much more likely to take a risk to avoid them.
I love this little story because it just nails the idea of framing perfectly. Look, the problem isn't outrunning the lion. That's impossible. The problem is outrunning the other guy. In finance, this is absolutely crucial. Amateurs think the game is them against the market. The pros, they know the game is them against all the other traders. That's the correct frame.
Okay, let's move on to our next mental bug, confirmation bias. This one's a biggie. It's our natural tendency to hunt for and pay attention to information that confirms what we already believe.
All right, take a look at this grid. Imagine a trader has a theory that a certain bearish index predicts stock returns, and for proof, they point right to that top left box. See? 60 times I predicted an increase, and it happened. I'm right. But what are they ignoring here? This, right here, is a classic confirmation error. Our trader is so focused on those 60 positive hits that they're completely ignoring the 45 times they were wrong and the 55 times their model missed a drop. We naturally hunt for the evidence that proves us right and just conveniently disregard the stuff that proves us wrong.
And this bias pops up everywhere in finance. It's why we obsessively check our portfolios when the market's up, but can't bear to look when it's down. It's why we're so quick to sell our winners, but hold on to our losers, hoping they'll come back. And it's why we study superstars like Warren Buffett, but completely forget to look at all the people who tried the exact same strategy and failed miserably.
Next up, we've got anchoring. This is a really powerful bias where our brains get stuck on the very first piece of information we see, and it influences every decision we make after that.
Okay, quick, no calculators, take 5 seconds and just guess the answer to these two problems. Go ahead. Now, even though they're the exact same problem, I'm willing to bet your estimate for B was way higher than your estimate for A. Why? Because your brain anchored on that first number it saw, 1 versus 8. By the way, the real answer is 40,320.
Now, in the world of finance, one of the most classic anchors is the 52-week high. Just look at this chart. It shows merger and acquisition offer prices. See that massive dramatic spike right at the 0 mark? That means a huge number of offers are being made right at the 52-week high. It's a number that has almost no real economic meaning, yet it's heavily influencing multi-billion-dollar decisions.
And you better believe companies know this and use it. Here's an actual slide from a shareholder presentation for Cablevision back in 2007. They're trying to sell a buyout offer, and what do they compare it to? You guessed it, the 52-week high, the 3-month high. They are explicitly using these numbers as anchors to make their offer look more attractive.
All right, let's look at another mental shortcut, representativeness. This is basically our brain's tendency to judge situations based on how closely they match a stereotype or a mental model we already have in our heads.
You know, the story of Elizabeth Holmes and Theranos is just a tragic masterclass in this very bias. Investors saw all the classic signs of a visionary founder, right? She dropped out of Stanford, just like Jobs and Zuckerberg. She wore the black turtleneck, just like Steve Jobs. She had this huge world-changing mission. All these things represented success, so investors completely overlooked the fact that the actual technology, well, it didn't work.
And that's the key mistake, right? Investors were so captivated by the stereotype, how much she looked like their idea of a genius, that they forgot to check the base rate. They never stopped to ask the really important question, statistically, what's the actual probability that a brand new technology like this will even work? The compelling story completely overrode the cold, hard facts.
So, we've gone through framing, confirmation, anchoring, and representativeness. And these aren't just little quirks, they are deep-seated bugs in our mental software. So what's the takeaway? Well, the goal isn't to get rid of them. That's literally impossible. The goal is to be aware of them.
Think of this as your new mental toolkit. Before you pull the trigger on any big financial decision, just pause and run through this checklist. Ask yourself, am I reacting to the real info or just the way it's framed? Am I honestly looking for the truth or am I just trying to prove myself right? Is this number I'm focused on actually relevant, or is it just an anchor? And am I looking at the hard facts or have I just fallen for a good story? This, right here, is what separates the best from the rest.
Ultimately, having this awareness is your edge. In a market full of people acting on these biases, your ability to pause, to step back, and to ask these questions, that's the first real step toward making smarter, more rational choices. So the only question left is, which of these biases is at play in your next big decision?